Hello, friends. Welcome to the Thrive Forward podcast. We are happy to have you here today and having a bit of an in-depth conversation around long-term care, extended care, the care that you need beyond just hospital care, long-term disability. This type of care usually occurs more so at the end of our lives. Although it can occur at different points in our lives, it is something that most genuinely does occur at the end of our lives. And this is a hard conversation to have. Not everybody wants to talk about these types of things that are happening in our lives and the overarching cost that it takes us to be able to provide care, because it is not something that is covered in any of our healthcare plans that we have. Now, you're going to have skilled nursing home care and hospice care that might be covered underneath your health plans, but most of them are not going to cover long-term care. And I'm going to specifically talk about it in terms of longer-term instances where we might need care when it comes to memory care, where we are going to need it for longer periods of time. On today's episode, we're specifically going to get into the nitty-gritty on what elements are available for you to plan around and why is it so important for you to plan on it earlier rather than later. So if you are in this midst of caregiving for someone else, we can talk about how assets should be spent down. But if you are in, I would say, this pre-planning stage where you think, you know what, this might happen to me, this might not. This is the time to start having these conversations. The reality is each one of us are going to be touched by the need for care in one element or another. We're either going to need it ourselves, our partner is going to need it, or someone in our life is going to need it. We will likely unescape this life without having to plan for care for someone in our lives or for ourselves. So stay tuned on this episode where we start to break down the costs of care, what you can do about it, and what types of solutions there actually are out there for that rising cost of healthcare needed at the end of our lives. All right, friends, let's start to break some of this down. Get your pencil, get your notepad. Also, remember that any of the things that we're talking about are very personal. So some things might work in your personal situation, some things might not. So I always encourage you to make sure that you sit down with your financial professional. If you don't have one, hello, happy to help. But these things are personal. Money's personal. Any strategy that you're going to take is personal. These are conversations to be had to spark more conversations and create educational resources for you. So by no means are any of these things that we're going to talk about today any advice. That being said, we're going to talk a little bit about what does Medicare actually cover. We're going to talk about what are the resources out there to plan for, when should you start planning, and what elements are you unable to completely plan for. So let's roll up our sleeves and get started. Starting with Medicare. So oftentimes I get this conversation that Medicare will cover any cost that I will need for long-term care or my parents will need for long-term care. And y'all, that is a fallacy. Okay, they will cover maybe some things, but they're not going to cover the long-term elements of care. If you were to need memory care, they're not going to cover it. Let's say you have a stroke and you are going to need care in your home. The likelihood after a certain period of time that they're going to cover care for you, very unlikely. So let's talk a little bit about what they will cover. So if you are admitted for a hospital stay, you have to be admitted as a patient for 3 days. So you have to be taken in as a patient for a minimum of 3 hospital days. They will not cover you for longer than 30 days while you're admitted into that Medicare certified facility. So again, it has to be a Medicare certified facility. Your need for care while you're there must be a need for skilled care, like physical therapy, speech therapy, or other elements of rehabilitation. So not everyone is going to fall into that situation. That might be a situation of an accident, a stroke, or something like that, where you'd be able to cover some of the beginning stages. So under the original Medicare qualifications, you will be qualified up to 20 days of nursing care for 100% of your coverage on Medicare. But again, you might need to revisit some of these things in your own personal situation. After day 21, from day 21 to day 100, you are going to be responsible for some of those costs. So they will not cover 100% of your care after day 21. After 100 days, all of your Medicare cost coverage goes away, and all of the payments are at the responsibility of that individual. So there are differences between Medicare and Medicaid. Medicaid is set aside to help individuals who are in financial need. This can apply at several different ages, but most frequently this occurs when we have reached a spend down or you are in a lower income bracket. You have to go through qualifications in order to be covered underneath Medicaid. It's not a simple process. It is something that does require quite a bit of paperwork, and you still are potentially in need of covering some of the costs. That might be co-payments or different things like that. You might also have what are called liens put against your properties if you are in home ownership. In the state of Minnesota, I said Minnesota, really Minnesotan when I said that, sorry, digress. It's kind of like we're just sitting here having a conversation when I do these solo episodes, my friends. In the state of Minnesota, we are held to spending down to $3,000 in assets. You're allowed to have one house and one car. What that means is if you have a family cabin or if you have an IRA that's worth more than $3,000, and you have two cars in your household, you are likely going to need to sell or spend down any of those things. There is also what we refer to as a 5-year look back period. That 5-year look back period is looking back at any assets that you might have repurposed to another individual in your life, a child, a spouse, a trust, something else. You're going to have a 5-year look back period that does say, okay, in these 5 years, did you give any money away to try to shelter it away from this type of expense that you would qualify for? If so, you're actually responsible for making up those dollars. So for instance, sometimes people start that gifting process of giving their loved ones, $10,000, $15,000 a year to spend down those assets. Well, spending down those assets, let's say you gave your children $20,000 and fast forward, you are going to need care 2 years after you're given that, you're still responsible for covering that dollars. Then when you've made that back up, and let me tell you, they keep track of everything, then you will be responsible for that level of care. So that's the difference between Medicare and Medicaid. So that's why planning is really important. You see in this conversation, not everything is covered, right? And so where does that gap plan come in for you? Where does that gap coverage? What happens? We know that with a caregiving journey, it doesn't always start with the first visit going straight into a nursing home situation. So our first instance with my dad is that he's been receiving care at home. And we are lucky to say that we are still able to care for him at home after being diagnosed with Alzheimer's dementia for 6 years now. That being said, there might be a point at which my mom is no longer able to care for him. I love my mom, but she is smaller than me. And we are all of maybe 5'2" on a good day, standing up real straight. And Mom, I love you, but you're maybe 100 pounds soaking wet. And not me, but mama is tiny, and dad isn't a small human. He's not a large human either, but her having to take care of him at some point in time, we're going to have to transition. And if you missed my episode on the sandwich generation, where I started to talk about some of the statistics on caregiving and the financials, let's rewind and go over a few of those numbers. So if you are going to start at that stage of welcoming somebody into your home, you're going to start with probably a home health aide that's going to come in And a lot of times people are like, Shannon, I want to stretch out that period at home as long as I can. And if possible, have that be the space where I experience the end of my life as well. I joke with some clients with their homes, take me out 2 feet forward, right? Like that's the space that they're in. They don't ever want to leave their home. And I can't imagine wanting to leave my home either. And so I know what that level of independence is. Hello, fly, if you're watching the video. Yes, there's a fly in the studio today, my friends. It's very distracting. Anyway, again, I digress. It's a funny day of recording in the Thrive Forward podcast studios, aka the Forethought Planning headquartered studios. Anywho, when we start to think about these transitions, the cost is going to start low, but it is going to expedite exceptionally to large dollar amounts by the time you might need around the clock care, either in your home or you're needing care in a facility, whether it be assisted living or a nursing home. So looking at it from starting at $150 an hour to going up to, depending the net level of care you might need in memory care, around the clock care, $100,000. And again, this could change with the facility that you decide to sign up with, the state in which you live in, so many different variables, right? So we're using kind of averages across the United States. That being said, a private room in the state of Minnesota is going to run you about $12,000 a month. And I say private room because a lot of people still want to be able to have their privacy, right? You're moving them from their home into a facility. If you want to stay at home, it's going to be usually $150 an hour for a home health aide. And at some point in time, you might need to have a registered nurse come in and visit you. That price is going to exceptionally increase to around $350, depending on where you are in your, where you are in the United States, whether you are urban, rural, suburban, where you are, right? All of those numbers can vary. That meaning that your journey financially can increase. And how do you start with paying for some of this if Medicare and Medicaid aren't going to step in? It depends on where you are in the planning process, right? If this is something where you're not experiencing any symptoms, you don't have any legacy of this, you're a healthy individual, you can start planning very young for looking at those what ifs, as I call them, in life. The biggest part that I tell clients when we start to do financial planning that impacts them is actually not the fluctuations in the market. We have to know that there's risk when it comes to investing, but at the end of the day, that's not the largest risk that we're going to have against our portfolio. The largest risk and expense that we're going to have is the need for care. How long will we need it for? What type of care will we need? Those are a lot of question marks to ask ourselves. And so many times throughout history of trying to fund these types of needs in our lives, there have been so many different products out there. And what can be trusted? And is that really real? Or is that just somebody selling me something because there's a large premium? There are so many different misconceptions that go with trying to plan for the cost of care. So I wanted to break down a few different pieces for you, right? So in my earlier episode, I talked about inflation and the cost of care increasing. So that, $150 an hour to $100,000 of a year for nursing home care is increasing at about 7% on an annual basis. That's inflation. What is it growing at, right? That's an alarming number. I don't want to think about 7% year after year from now until I'm in my 80s or 90s. That's a huge cost. I hope to goodness we can come up with a solution for that cost of care as I grow older. But what that means is how do we just spend down all of our money? Do we not leave anything for our kids? How do we plan for that? Some individuals are like, I can self-insure. I don't have to. I'm going to save all these assets in my investments. There are so many different things to think about. Okay, here, let me start with this. What do you have access to? What is the most important piece? Access. When we start to access our money, how are we going to get it? Are there penalties? What are the tax implications? What are those things? If you want to self-insure, that's great. But what are the other things that are going to come across? As you have investments, there's going to be some type of tax, whether it be capital gains or income tax, that you're going to have to access. What does that look like in your overall financial plan? Usually when we start to need care, we are in our more experienced years of life, as I will say. And we are probably taking what the lovely IRS makes us take from our retirement plans, which are required minimum distributions. Now you're going to take added distributions for care. That might exponentially grow your tax bracket and then grow your tax liability. So you've got to think about those things when it comes to self-insurance. And then I have like some individuals like, I'm not worried about it at all. Not worried about it at all. That's great. Wonderful. Good for you. Most individuals are actually very worried about what could happen to themselves or the people that are around us. So self-insurance is one way that you can do it. You can look at it from an element of your investments. Now, cash isn't paying you anything, my friends. So if you're setting this aside in a CD or money market account, it is probably not paying you much of anything right now. And if we're talking about keeping pace with inflation, the likelihood is that we're going to have to look to some sort of investment vehicle. Again, not here to make any recommendations. Those are very personal things that you need to understand. The other piece is looking at, how do you insure against this? Insurance, just like you buy for your car or your home, is protection against something that could happen against you or your life, essentially your life, or against your house or your car, right? So life insurance is an option to be able to look at. Long-term care insurance is an option to look at, and hybrid options are things to look at. The elements of insurance have definitely evolved over time, and not necessarily are they for everyone. Some people might be in that very specific spend down situation. And again, you don't want to purchase a long-term care insurance product or a life insurance product unless you know that you can actually afford to do so for a long period of time. So this isn't necessarily for everyone. Again, you should be having these types of conversations. But there are different tools and resources that can come to you and what are available. So let's talk about like this traditional long-term care insurance policy. This is like the policy that everybody knows about. You pay a premium, you get a benefit. If you don't ever use the benefit, you lose it. Kind of like car insurance. If you never get in an accident, you never use your car insurance from an aspect of like the liability that's associated with it. If and other types of insurance, but from a long-term care perspective, we're going to say you put in a certain dollar amount every year. Now, some of these policies might range anywhere from $2,000 to $10,000 a month. Some might be cheaper than that. Basically, any type of long-term care insurance or life insurance is going to be dependent on receiving a benefit. That benefit doesn't come into effect until you are unable, or the person who is insured is unable to complete 2 activities of daily living. So I talked about this before in a previous episode. Those are basically those elements of getting out of bed and what you need to get started on your day. So transferring in and out of bed, being able to get out in and out of bed, getting dressed, showering, bathing, eating, continence, being able to control your bladder, and lastly, going to the bathroom. So those 6 activities of daily living, if you're not able to complete 2 of them, then your policy will be able to kick in. This long-term care policy, though, it's like this element of like, I pay into it and I never get anything back. What happens if I don't have an element of needing long-term care? Then there are these life insurance or asset-based long-term care policies. Sometimes you can pay them over a period of time. If you are financially solvent enough to be able to put in a large premium, you're able to put in a large premium. What ends up happening with these types of policies is they are, again, effective once you're not able to complete 2 activities of daily living, and they spend down an accelerated benefit for you. If you were never able to use that policy, let's say you peacefully passed away in your sleep, which is what I hope for everyone, but know that that is probably unlikely. If you weren't able to use the policy or not use all of the benefit, then that passes to your heirs as a death benefit. Oftentimes tax-free, not every policy, again, you'll have to read into that. But like life insurance, it passes to your beneficiaries tax-free. Of course, you need to take into account estate planning aspects of things. What are your thresholds from an element of accumulated wealth if you're at that stage? That being said, those have become a lot more popular because it's not that use it, lose it type of mentality. And then you've got several aspects of hybrid policies within that. So within that lump sum type of benefit, there are benefits where you can invest a portion of the money. There are elements where you can index it towards, the S&P 500. There are elements of utilizing just whole life insurance where you're guaranteed a rate. Each one of these types of policies is going to have a different benefit for a different risk appetite, as well as a different benefit that's actually available on the last end. One thing that I caution all individuals when looking at those types of policies, and I'm very familiar with them because we utilize those resources in planning at Forethought. One thing that's very important is what is happening on the element of when you need to receive it. So when you need to receive those payments, when you are actually in the collection stage, you are receiving those care benefits. What does that experience look like for you? It can be a great sales experience on the front end, but what does it mean for you when you're actually needing that? So looking at insurance programs, what are their ratings? What is their solvency? What is their customer service experience? What are they actually being able to concierge for you? Are they going to connect you with facilities that cover and utilize their process? How easy is it going to be able to access those funds? So when we look at those types of policies, there's a couple different ways to receive them: through reimbursement, or what we use as a term as indemnity. Don't worry, we try to really confuse you in my industry, but the reality is one way is you turn in a receipt and you get reimbursed for it. The other is you say, I can't complete these two activities of daily living. You're evaluated by a doctor or a third-party professional, and you just get a check cut to you every single month for the dollar amount of the policy. A lot of times individuals like the indemnity policies, while the benefits might not be as large as the reimbursement, because it makes it an easy space for their beneficiaries to have access to the money when it's needed. Again, there are so many different aspects to these spaces, which is why it's important to start to have those conversations early. Now, a lot of times people will say, what about using assets and other things to be able to cover the cost? Some people are saying, take out a reverse mortgage, rent out your property, whatever it might be. These are all personal decisions that you need to look at. There are elements of every aspect that could work in very specific different situations for individuals. But again, it comes back to being able to create that strategy very early and know that it is something that creates a conversation and a plan of action, utilizing many different professionals in your life to make sure that you're planning from a tax perspective, a legal perspective, and a financial perspective. So making sure that you're involving those key individuals in that space. So what I want to be able to kind of wrap a bow around this conversation, because I could go very in depth with a lot of different solutions around long-term care planning, but let's be very clear here. Again, it is a personal situation. So this is something that you are curious about having a conversation around. Schedule a wealth assessment with us. We'd be happy to assist you. That being said, if you are younger, it is going to be easier to start having these conversations. What should you be saving? What are the things that you should maybe consider about access points for spending down? If you're going to self-insure, what are the buckets that you should be funding? What are the tax-free solutions that you have within your portfolio? What are the tax deferred? What are the taxable? What are some predictions of what that might look like from a cost perspective for yourself in the future? And how are you being very strategic? Not to mention, how are you strategizing in terms of assets? Do you have the ability to repurpose assets into other elements of, either donor advised, or if you're charitably inclined, or looking at trusts and what other solutions might be available to your family? If you have second properties, making sure that you're putting those maybe in a family trust to alleviate the ownership of one individual over the other. Planning can never start too early. planning can, in these perspectives, be too late sometimes, at least pre-planning. Planning is never too late, but pre-planning can be. And so it's important to start to have these conversations. And we are going to do an entire episode on how do some of those conversations sound, right? So how do we practice having some of those conversations with our loved ones? And I'm in the midst of having some of them with my parents as well. So I'll share with you some of our raw and real conversations that we've been having. That being said, if you are in this sandwich generation that I talked about last time, or I would say even, between the ages of 35 and 60, and you're a healthy individual and you want to start talking about how do I get to this space? Because you have to remember with insurance, you have to qualify for it, right? You have to be in a healthy state to be able to qualify for some of those things. Now, there are other solutions that might be available to us, like, again, self-insuring, looking at other options within the elements of savings and investment vehicles that might be available to you. But really with insurance, we have to remember that we have to qualify for it. And anything that you are going to insure yourself on, you have to also understand that that insurance is going to change with your health at the time in which you are applying for it, right? So I always tell people you're probably at your healthiest state today to be able to consider what you have going forward. Also, the younger you are, the more likely that your premiums are going to be less. So if this is something that runs in your family, we know that Alzheimer's and dementia can be something that is hereditary, not always, but it can be. Is this something that you want to pre-plan for and start having these conversations around what does this look like from a cash flow perspective for myself? What situation might I be in the future? Again, as I started this conversation, the biggest impacts to a financial plan are not necessarily investment fluctuation. We know that we're going to get that when we start to invest our money. That goes without being said, that we're taking risks when we put money into the market. What really does provide us a level of impact into our lives is when we need care and when we need to access that money. Again, the average cost across the United States can vary, but it can be as much as $100,000. How are you set up successfully to start to plan for that rising cost of care that's growing at about 7% every year? You don't really have a solution as to what that cost of care is going to look like or how we're going to remodel that and readdress it. But the reality is this could be affecting you and your family. So don't wait to plan. As I've always said in every single one of my podcasts, you are worthy of wealth. Worthy of wealth means starting those conversations, means being able to practice those conversations for when you need them, being able to actually implement the strategy before you need to implement the strategy. Pre-planning is a gift that you are given, my friends. And if you are at that status of being able to pre-plan, don't think too much about it and wait for something to happen. This is the element that you're able to start planning now. And if you want to start that planning, we'd be happy to walk alongside you and start having those conversations. Don't let this overwhelm you. I know that it can be a topic that is very detailed, and everything that I just talked about, I could have just been speaking in tongues for you. And if you would like us to break it down a little bit more into what it actually means for you, what does that look like? So when we do financial planning, we look at the probabilities of success of you being able to achieve all of the things that you want to. We talk about the goals that you want to have in the future. What does your life look like? What is that vision of your wealth? Where do you want to go? Who do you want to spend it with? And what does that look like? What does it smell like, feel like? All of those sensory aspects of things. We look at where you are right now and where you want to go. How probable are you to get to that space? And then what if a hiccup happens? What if something unexpected happens in your life? What impact does that have to your financial plan? So for instance, we plug into your financial plan. What if you were to have a long-term scenario of care needed at the end of your life? What would that cost look like and how would we cover it? That is a huge part of financial planning. It's not just the investment management. It's looking at those hypothetical situations that might impact you even more than several years of market fluctuation. So if that is something that you are getting very curious about, schedule your wealth assessment with us today. We'd be happy to help. And as always, we'll continue these conversations because we don't have anywhere else to go except for to learn and grow and start creating solutions. So thank you for joining us on the Thrive Forward podcast. If you thought that this episode today was something impactful for you or your family or someone that you know in your life, please share. We would love to do that. This is our element of being able to provide free educational advice and resources. I shouldn't say advice, resources for those individuals throughout our community and beyond. So sharing this knowledge and resource is something that will help continue to provide those and close those educational gaps when it comes to finances. So thank you for listening, and we hope that you always remember you are worthy of wealth.